Markets have been ripping lately. If you are feeling like you missed the boat, don't worry. In today's video, I'm breaking down 5 stocks that still have huge upside left, even after this rally. From trillion-dollar tech to a gaming beast and beauty stock nobody is talking about. With explosive growth, I'll walk you through exactly what I'm watching and the price levels I'm planning to buy. What's going on, investors? Hopefully, guys are doing well out there. Starting from the stock number 1, Amazon is trading above $200 per share, back in the 2 plus trillion dollars club. Is it too late to buy Amazon stock? Amazon's business is huge and diversified. The core is still e-commerce, online store sales plus fees from the third-party marketplace. This drives volumes, but profits actually coming from other segments. Amazon Web Services (AWS), the cloud computing cash cow. AWS pulled $29.3 billion in revenue in Q1 2025 alone, up 17% year over year, and over $100 billion in sales in the last 4 quarters, with 40% operating margins. The second, advertising. Yes, Amazon is an ad giant now. You probably saw a lot of sponsored listings on Amazon. Also video ads in Twitch, etc. Ad revenue jumped 19% year over year, hitting almost $12 billion in a quarter. It's high margin and growing faster than core retail business. The third, subscriptions and others. Here included Prime memberships, digital content, Whole Food stores, Alexa devices, etc. Steady growth up to the right, and most importantly, recurring revenue stream. Amazon's start to 2025 has been eventful. Q1 2025 sales came in $155.7 billion, about plus 9% year over year. Not bad for such a large company, but the outlook disappointed investors as it was slightly softer than expected. Management probably is sandbagging because it's quite difficult to predict how tariffs will affect the business. My bull case on Amazon is robotics and significant efficiency improvements. Amazon will be soon generating north of $1 trillion in revenue in a year, and just a few points improvement in margins will bring tens of billions of dollars to the bottom line. I see Amazon as a dominant platform with multiple growth engines. A realistic near-term bullish scenario might be Amazon pushing to $250 per share, new highs in 2025, assuming tariffs tension cool and AWS reaccelerates. At $210, Amazon is trading at 15 times forward operating cash flows. This is dirt cheap compared to historical averages. And I believe price to operating cash flow is the right way to value Amazon, because the company did not even start focusing on profitability. Coming to stock number 2, Alphabet. I think if you ask which stock has had the most drama in recent weeks, most investors will reply Alphabet. With the news that search volumes are declining in Apple's Safari, meanwhile Sundar Pichai commented on the All In podcast that he sees a lot of opportunities in AI for search instead of disruptions. This stock is really a hard one. Let me explain why I believe the recent dip is a buying opportunity. Google has a lot of uncertainties and risks. DOJ investigation of monopoly in search and competitions from LLMs. For the first time in ages, Google's search market share dropped under 90%, with more people, including myself, using chatbots for a significant amount of queries every single day. In cloud, Google is still third behind AWS and Azure, though the market is growing so fast, so I would say they all can win. And in social media video, TikTok rise is a threat to YouTube attention share. YouTube responded with shorts, but monetization there is still early. In terms of DOJ investigation, I recorded a video where I valued every business segment of Alphabet separately in case of the breakup of the company to find out what is the true value of Google. Make sure to check that video on the channel later on. I have a large position in Google in my public YouTube portfolio, and I'm looking to add more under $150 per share. Why exactly this price, you ask? Very simple, fundamental plus technical reasons. From a fundamental point of view, Google is already cheap, historically trading at 18 times forward price to earnings, with 10 years average medium of forward price to earnings of 22. From a technical perspective, this will be the bottom of the decade-long channel, plus retest of the previous all-time highs. Very strong technical level. Fundamentals tell you what to buy, and technicals tell you when to buy. If you're enjoying video so far, please consider subscribing to the channel. On the channel, I do fundamental analysis on stocks, deep dives, I run public YouTube portfolio with 12% year to date so far. I do invest in educational videos. If any of that interests you, welcome to join. With that being said, let's continue with stock number 3. Meta Platforms, from bust to boom. Meta has pulled off a dramatic comeback. The stock has crashed to $90 per share in 2022, has soared past of $730 per share by early 2025, rejoining the exclusive trillion-dollar club. Meta owns Facebook, Instagram, WhatsApp, and Reality Labs division, virtual reality and augmented reality. The money engine is advertising on the family of apps. This includes Facebook, Instagram, WhatsApp, Messenger, essentially all the social platforms. Meta monetizes primarily view ads shown in Facebook and Instagram, feeds, stories, reels, etc. Most of the revenue is generated by family of apps, and virtual reality segment is burning north of $20 billion per year in operating losses. It's a long-term bet on a metaverse, but right now contributes little revenue. The bull case on Meta is advertising demand is robust. Wall Street expects Meta to hit $187 billion in revenue in 2025, a record high revenues, implying 13% growth year over year, which is quite bullish. Meta's price to earnings currently is 25, which is not dirt cheap, of course, but for such a high quality company, not too crazy to pay as well. So if they continue growing and expanding margins even more with AI tailwinds, the stock could have room to run to all-time highs and higher. Bulls also love that Meta has become very shareholder friendly. The company has been doing huge buybacks, tens of billions of dollars every single year. They reduce the share count, boosting earnings per share. With $40 billion in free cash flow, they can keep returning cash to shareholders. Another angle, AI is expected to supercharge Meta's ad business. Better AI recommendations means more time spent on Reels. Meta disclosed Reels time on Instagram was up 24% thanks to AI in late 2024. And they finally started monetizing Reels effectively, an additional $10 billion revenue run rate announced recently. On Reality Labs side, both view it as a long-term call option. Meta is on my watch list, even though I have a position in Meta already in my private portfolio and public YouTube portfolio. I was planning to buy at around $340 per share. By the way, I shared my top 10 stocks in a watch list and the undervalued buy prices I was planning to add during this terrorist market crash. If you do not have a watch list, make sure to check that video. It will allow you to take advantage of market volatility like we had in April and buy highest quality companies with ridiculously low prices. My price target for end of the year for Meta platforms is $750 per share. Stock number 4, Evolution AB. You might not know Evolution AB, but if you've ever played an online casino game, there is a good chance that they were behind it. This Swedish company became a juggernaut, providing live dealer casino games to gambling sites worldwide. Its stock soared multifold in recent years. But in 2025, Evolution's growth slowed, and this is the worst that can happen to a growth company. I just recently did a deep dive on Evolution Gaming, and you can find the video on the channel. Evolution Gaming has two main business segments, live casino and random number generator. The most important is live. Evolution is providing software solutions to casino operators, very high margin business, and EBITDA margins around 70%. Evolution is rewarding shareholders with buybacks and dividends. By early 2025, Evolution was a market darling, often trading at high multiples given its growth. Recent developments in Q1 2025, for the first time, Evolution's growth slowed dramatically. In Q1 2025, revenue was $520.9 million, up only 3.9% year over year, far away from the number Wall Street and investors were expecting. Worse, EBITDA actually fell 1%. Margin slipped to 65.6 from 69% and EPS was slightly down. When these results hit, Evolution stock plunged 20% in one day. Growth investors are selling out of the stock, but I believe that turnaround is near, and in 6 to 12 months, Evolution's growth will reaccelerate. Company has a strong moat with many studios across the globe. Switching costs, as casino operators will not be so easy to switch to another software provider. For more detailed deep dive on Evolution, please watch the video on the channel. I went there in depth, covering the business, risks, and potential upside for investors. I already started a position in Evolution Gaming, but I could add more at 600 Swedish kronas per share. It will be at the bottom of the downtrend. Just to clarify, from the technical perspective, this is not bullish at all because the stock went pretty much nowhere but down. This is more like a turnaround play. If management can solve the main issues with cybersecurity and stop declining EBITDA margins, this stock could at least double to the top of the channel or even go higher. Company number 5, cosmetics beast, Elf Beauty. How did a cosmetics company named after elves become one of the hottest stock on Wall Street? Elf Beauty did exactly that. Its stock skyrocketed from mid-2022 to its 2024 peaks as the company disrupted the beauty industry. Now ELF declines significantly from all-time highs. Let's dig deeper what's the reason of the decline and if this is a generational buying opportunity. Let me explain why I think this is the big opportunity in the market right now. ELF sells affordable cosmetics and skincare products, often priced much lower than prestige brands, but with quality that wins over consumers, especially Gen Z. From the product's perspective, ELF has primary color cosmetics, makeup like lipsticks, eyeliners, foundation, etc., but also skincare and other beauty tools. They are known for on-trend, high-quality products at drugstore prices. Distribution. This is the one of the biggest strengths for ELF Beauty. ELF is everywhere its target shoppers are. You can find them in Walmart, Target, Ulta, CVS, and other major retailers. Plus, a strong e-commerce presence, their own website and Amazon. What I really love about ELF is their marketing strategy. ELF has been crushing it on social media. They create viral campaigns, partner with influencers, and do collabs. Financially, ELF went from a small niche player to number 3 brands in US drugstore makeup by market share as of 2024. In fact, they've gained market share for 5 consecutive years. ELF has a lot of opportunities to grow. International sales in the recent quarter grew 65.8%. So for investors, ELF offer a rare mix. Recession-resilient consumer staples, makeup is relatively resilient during economic downturns, with tech-like growth rates, 30% plus. Which of the companies did you buy during the market pullback? Let me know in the comments. I promise to read and reply every single one. If you found this video valuable, please consider subscribing to the channel. I really appreciate your time watching until the very end of the video. That's all for now. I will see you in the next one.